So first and foremost, I'd like to thank everybody for joining our session today. Really, this is focused in a very interactive way on helping to justify the budgets for contract lifecycle and contract analytics. Part of that, of course, is building a business case. Joining us today, and really someone who I think we've all came here to listen to, is Andrew Bartels, Vice President and Principal Analyst for Forrester Research.
Thank you.
So, with much ado, of course, even looking at this screen, clearly you get most of the ink and most of the lines, Andrew. But for folks who don't know you, I tend to think of you as sort of the leading analyst in contract management, contract analytics for the industry overall. Certainly your history with Forrester as it relates to technology across the life cycle, as well as broader technology, cloud, AI, is paramount. And I'm happy to say that I've known you for the better part of, almost 15 years. So I think you've been in this space for longer than that.
Correct, since at least 2000. So it's coming on 20 years of touching on this.
And even 20, I like it. The floor is yours, sir.
Okay, well, thank you, Art. As I mentioned, I've been covering contract lifecycle management since usually 2002, 2003, somewhere in that time frame. In fact, just looking back, we did our first Forrester wave evaluating CLM back in 2006, I believe. So it's been a lot of change in the market. But as part of that coverage, I've also had to spend a fair amount of time thinking about the value proposition for CLM and how that translates into an actual business case. And what that means is the business case involves several parts. At first, it involves getting budget for it. Building the project ROI to say, this is a good investment, this is why it's going to pay off. But also not just building it, but then also how do you translate that pre-implementation ROI into actual benefits? And how does that translate into actual process improvements? One of the key things or themes you'll see as we talk about CLM is the importance of looking at CLM value through two lenses. One is what is the traditional ROI, which is around efficiency gains, productivity gains, being able to cut costs. But the other is what we at Forrester try and call effectiveness improvements. You can think of efficiency as reducing waste in inputs. Effectiveness is reducing waste in outcomes or outputs, making sure you get the desired outcomes from what's happening here. And in building a business case for CLM, you've got to look at both of those two parts, the efficiency gains, the effectiveness gains. Next slide, Art. So this is important because as you look at the value, at what role contracts play, it becomes very clear that they play two different roles which kind of align between effectiveness and between efficiency. So if you actually look at a typical contract, about 5%, maybe 10% of the wording in that contract is devoted to defining who does what at what price when everything works as planned. The other 95% of language is devoted to who is liable or responsible when things don't work as planned. These two pieces, two roles actually are important too because they relate to different stakeholders. The primary ones around the, the first one about who does what at what price appeals to the head of sales, the head of procurement, the folks who got the contracts with your customers, with your suppliers, and responsible for turning agreements into contracts that then get executed. And that's where they focus. On a day-to-day basis, that's where 95% of the value of contracts comes because most contracts simply get executed as they're designed. But legal in particular looks at the second part of it, the liabilities, the responsibilities, and making sure contracts cover all the contingencies that might arise. On a day-to-day basis, that may not be a factor. But every once in a while, things go badly wrong. And when they go badly wrong, they cost a lot of money. And so on a day-to-day basis, that responsibility liability section of contracts may be only 5% of the daily value. But if you look at the lifetime of a contract and look what happens to to the business cost, if 1 or 2 or 3% of contracts go bad, you can see almost half of the contract of the value lies in that other part of it. It's dealing with those contingencies that are there. So we'll go to the next part of it. So what do we mean by contract lifecycle management? Well, contract lifecycle management is a set of technologies that are designed to help firms manage the contract lifecycle. I first, I think, came up with the term contract lifecycle management because I want to distinguish in the market from 2 types of technologies. One, which we call contract management, which treats the contract as a document. We viewed, a document is only a small part of the value of a contract. The actual real value of the contract lies in the specific language, and each of those elements of language need to have controls over what can be changed or not changed, need to have rules and workflow about who needs to approve those changes. And you need to extract from that contract language the relevant values that represent deliverables you're going to be doing, you're executing in your relationship. So CLM covers all these stages. It supports all the stages of the contract, from drafting to negotiation to execution and ultimately to replacement. It provides support for all kinds of contracts, not just the obvious ones like buy-side or sell-side contracts, but employment contracts, intellectual property contracts. Any kind of contract you have, any kind of agreement can be supported here. Another piece is it needs to have multiple varieties of interface in the system, including especially Word document interfaces. Because you've got many different people who work in these systems, and lawyers in particular work on them heavily, and lawyers the Word is the environment in which they operate. It's a rare lawyer you'll find doing Excel or PowerPoint, but Word is what they live and breathe in, so you need to have that as the interface. But you also have browser interface, other forms of interface for employees who may not be using Word as the application they live in. They may be using Salesforce. They might be using a procurement system. You want to have a repository where the contracts upon completion go, but not just as documents, but as disaggregated elements. And those elements of the contract then can be integrated and linked to purchasing systems, order management systems, invoice systems. So on a day-to-day basis, those systems that are executing the relationship with customers or suppliers have access to the contract data they need to make sure those execution of transactions are compliant with the contract. Contracts themselves are not single objects. Contracts make up a corpus, a portfolio. And it's important to understand that full portfolio, to understand all the contracts in there, all the ones you might have with a counterparty, a customer, or supplier, regardless of whether it's parent or subsidiary. All the contracts you have that might expire in July 2021, all the contracts that might have force majeure in it, and the contracts that have GDPR, any number of different issues. You understand what you have in there. You also want to be able to handle import of contracts, because not all contracts will be created in the system. In many cases, 10, 20, 30, 50, 70%, 80% of contracts may come from counterparties. You've got to be able to pull those contracts in, apply the right metadata tags to the relevant language to match up with the ones you use, and bring it into the system so you can then work it, whether that means taking that draft, taking that third party as a draft, and then negotiating, redlining it, turning it into a final contract, or ultimately pulling into a repository so you can track it and handle it the same way you're handling your native born contracts in your system. You've got to be able to link it to the systems where contracts get used, not just in the transaction systems, but to the processes that are used by your employees in their daily jobs. In the sales side, linking it to the systems that are used by salespeople to manage their leads and their proposals and their relationships. Similar story on the supplier side. So CLM covers all of these, and this makes it very complicated. Next slide, Art. Now, in the course of this 20-odd year of work I've done here, we've been able to work through or identify sort of 6 sources of value. Now, these sources of value often come sequentially. They don't necessarily have to follow this sequence. We do find some companies who bypass the first step to go directly to contract creation and then work back up again. But most commonly, they follow these sequence of implementation. And as I'll come to admit, each of these has a source of value, which I'll detail. But it's the holistic piece of this, which is the real opportunity. Not just to get your contracts in a repository, not just to run basic reports on, not just to create the contracts in them, but to connect them with the upstream maps, to integrate them in transaction systems, and then use all the data and all the information, all the intelligence you're getting here to figure out how do we improve our contracts. So let's go through each of these sources of value, because this is what builds the ROI case on it. So Art, next slide. So let's start with the contract repository. So the business value here, you can really put in 3 key buckets. First, and kind of most obviously, it eliminates the cost of pulling contracts and distributing to those who need those contracts. This is not a trivial expense. In companies that have contracts and filing cabinets, there are calls that come in, emails that come in to the legal department. Hey, can you pull that contract? Can you send it to me? You avoid all that. That goes away. Another one is avoid auto renewal of contracts that are about to be canceled, or that you don't want canceled, or avoid expired contracts that you want to keep. So those are very tangible sources of value. They show up then in kind of substantial results. So certainly reduced legal operations expense. This is a productivity gain, efficiency gain. But they also get benefits for lower contractual spending by avoiding high-cost contracts, making sure those high-cost contracts you entered in 2 years ago that looked good at the time now don't look so good, you're not stuck with them. That's an effectiveness gain. Similarly, it's increasing revenues by keeping profitable sales contracts and ending unprofitable ones. Again, making sure the contracts that you keep are the ones that deliver the most value to those. Those, again, are effectiveness gains. Next stage is around analysis and reports of contracts. A couple of areas here, identifying duplicate contracts or contracts that have non-compliant language. That's at an individual contract level, but also looking across the whole contract portfolio for risks, entitlements, obligations that you have as a company to your business partners, to your customers. So again, efficiency gains, reducing legal operations expense because it makes it a lot faster and quicker and easier for getting reports that would tell you how many contracts do we have that are due to expire in July 2021? What is the total value of those contracts? In the absence of this, it takes a lot of manual time to go and find those contracts, do the calculations. There's a lot of savings there. But equally important, it moves in the effectiveness category, making sure your contractual commitments are kept, and thereby avoiding penalties for late payment or for failure to perform. This is an effectiveness gains. Again, you do contracts. The contracts have liabilities if you don't perform. You can avoid those. Making sure your contractual entitlements are realized in terms of revenues or savings. And understanding and addressing risk before they happen and avoiding financial losses. These are all 3 of these. I'm sorry, go back just for a second, Art. The latter 3 of these really are probabilistic calculations. You need to figure out what's the probability that's happening in the past, what's the damage that might arise, and then apply that, the damage times the probability, to come up with a business case on that. Next slide, Art. So this is where you see a lot of the business value, contract creation. This allows business users to create the contracts they need to close deals. But it's also maintaining legal controls to make sure the contracts created are aligned with company policy, with company requirements. So one major efficiency gain is reduced legal time in reviewing contracts. Rather than having lawyers having to read through every contract to look for the deviations that could be problems, the system does that. And it flags any deviation from preferred language, routes it to the appropriate lawyer for quick review. Yep, this is okay. Nope, this is not okay. And stops it if it's not okay. That can reduce legal review times by as much as 80%, because think of the time savings. So a big business case falls under that one. But it's not just the legal time that's spent, it's the cycle time. Instead of having contracts that are tied up with lawyers waiting to review it because they've got 16 contracts they're all reading through, and yours is number 16, and they got the other 14 or 15 to read through before they can get to yours. That takes 2 weeks, therefore you're behind. You can now get this done much more quickly. So faster time to create and finalize the contracts turns into earlier recognition of contracted savings or contracted benefits. One of the areas we've seen is a lot of companies typically have a lot of deals, especially on the sales side, that close on the last few days of the month. Because we all know big business customers have learned to say, look, we're going to hold off to the very end. We know you as a supplier. You're going to give us the best discounts to close deals. But you don't want to have that deal then stuck in legal. So this cycle time brings it faster and then brings forward into the current time, into the current quarter, financial savings or financial revenues that you wanted to get, and allow you to recognize those in this quarter, not in the next quarter. And that's a time value, a business value. And of course, it reduces the risk of rogue contracts that arise, that go out there without legally knowing about it until it services, and they've got unintended liabilities that you didn't want to address. Next slide.
Andrew, if we move to the next slide, if you were in the business of, let's say, a large-scale capital build projects, you might have a multi-year contract, derivative statements of work, task orders, certainly regulatory and environmental compliance. Would you see any particularly strong business value case or a different model for sort of scaling financial results across these lists?
Well, I think it's more in the next stages than in this stage, because it's really at the contract value stage. But it is certainly a key value. I put that more in the next couple of ones we're going to get to.
Okay.
So the next one is connecting with upstream apps. This is partly a little bit there, but not directly there, because this gets into the efficiency of salespeople or the efficiency of purchasing people in terms of being able to link and integrate the contract creation process into the other tasks that they do. So again, having an integration here means that a salesperson can be tracking a lead in Salesforce, for one example, and then turn that lead into a proposal, turn that proposal into a contract in the same interface, in the same way of doing it, so they are not popping in and out of different systems, not having to wait for it to do. There are efficiency gains that arise for people by being able to have this in a seamless fashion that's integrated. It also, that leads then to productivity gains. It means that you can do more contracts, either creation or contract reviews in a quarter or in a month. Because again, the ability for those people to work with a contract in context with all the other parts of the relationship, including some of those types of long-term complex contracts that have lots of phases and lots of deliverables and lots of other parts of it. Now that streamlines that process and makes it much more effective and efficient to manage that. It also means that you get a higher proportion of business deals that achieve the expected benefits because you have more effective management of the relationship. Again, the people who are working on those later phases of managing obligation, managing stages, managing the piece of a project, have that contract information right in front of them. It's not somewhere else they can't find. They can use it then to make sure that each of the milestones are being met, each of the connection points are being tracked. And again, might get much more effective management of the relationship that is defined in the contract. So that's part of the story you're getting at, Art. The next part also comes along here, which is the next one, which is integrating with transaction systems. because in some cases, the relationship is actually one that is transaction-based. It's a purchase order, it's a sale, it's an invoice, so which is defined in the contract. So you'll be able to execute those automatically by integrating the contract data into the order management system, into the purchasing system, into the invoice system, even into the customer service system. You know, some contracts specify that you get platinum level service, others you get gold, you get silver. Having that data pulled in the customer service system helps make sure that the customer gets the right level of service to which they're entitled to in the contract. So financial rewards, increased compliance with and getting expected savings from your contracts. Increased compliance with and avoiding penalties, delivery of value and sell side contracts. And of course, avoidance of any legal penalties or publicity for failure to meet contract terms. Again, these are probabilistic calculations. These are effectiveness benefits, but they're very real and very timely. And increasingly, we're seeing this focus on obligations and managing obligations as a new area of the company to focus on. It's not just the contract creation, it's managing obligations on the contract that's important. And the last stage of value, it comes when you're able to look at this holistically. You're able to look at the contracts that you're doing and compare them with the business results you expected. And by doing so, start to identify gaps. There may be gaps in contract language. We have had a series of deals that went south, did not perform they wanted to. The reason was we failed to specify in the contract what we were supposed to do, what the other party did, and therefore had misaligned expectations. We need to correct that. We need to then add these into our contract language so it's clear what the obligations are, what we're supposed to do. It's also a way of improving the contract process to be able to get faster and better contracts. And so financial results here are having contracts that always deliver the expected benefit or expected business results, such as contractual protections against failures or fully aligned deliverable expectation, reducing the probability of revenue or cost surprises due to adverse events, and of course, a lower cost, higher impact process for creating managing contracts overall. To be clear, this stage is extremely rare. We have found maybe 1% of clients of CLM who are at this stage. It's very, very rare. And yet in many ways, this is the gold standard. This is the ultimate point you want to get, because this is what's going to really deliver, in many cases, the biggest business value of CLM. It's when you're able to get this point, this perspective, this point where you're looking at your contracts as mechanisms that are not just static, but ways of really driving clear, high value business relationships on both your customer side and on your supplier side. So let's go to the next slide, Art. What complicates this is that CLM sits at the vector of three different processes. One process is the lead to cash process, where it's lead management, CPQ, proposal, CLM, revenue management, order management. Others, the source to pay process, vendor analytics, sourcing, CLM, supplier management, procurement, and invoicing. Or intersection of legal operations, from legal matter management, CLM to e-billing. CLM sits at the heart of all of these processes. And it's part of why CLM is so complicated, is that it has to play in all these processes and play well in all these processes to add value. Next slide. But it's also complicated because you have lots of different stakeholders who have very different needs from a CLM system. And you need to address those. I'm not going to go through all of these, but clearly you've got contract initiators, contract reviewers, contract managers, risk managers, and other executives who need to be able to see value from this. So I have often said CLM is one of the most complicated systems to implement because you have so many different stakeholders who are looking at this in so many different ways. But these stakeholders, go to your next slide, actually look at different stages of value. This does help. Understanding who looks at this from different stages can give you a sense of who we need to engage in each stage And who we need to convince at each stage is that CLM is valuable. So legal, very clearly, contract repository, we've seen benefits there. Contract reports and analysis there. Contract creation is there. They don't really care though about linked to upstream apps or automated contract compliance. That's not their problem. That is the problem though of CPOs and head of sales. They care a lot about that. But things like contract optimization, absolutely. But one of the other things to note here is the role of CFOs. Most companies, 5, 10 years ago, never thought of a CFO as a client, as a user of CLM. Today, they are. Companies that have CLM systems in place have suddenly found their CFO calling up and say, hey, I hear you got this contract CLM system. I hear you've got data in that about all the contracts we have, all our customers, all our suppliers. That data tells us, doesn't it, how much we're supposed to be getting each quarter, each year from these customers? What's firmly committed? What's contractually variable? What's not committed? What's the time frame? What's the cost side? I need that analysis to understand our future obligations, our future entitlements. I am a client of CLM. And that creates a whole different stakeholder that many companies who've done CLM had never thought about, but they now have to think about today. Next slide. So before I'm going to hand this over to you, Art, but I think this is the key points I want you to take away. It's really, very 4 simple points. Think holistically across a contract life cycle. Plan for all the stages of CLM implementations. Engage comprehensively. Get all stakeholders involved, both legal and business. Don't stop with CLM when the contract is signed. You've got to address the issues of contract management, contract compliance, contract optimization. And spend as much time calculating, thinking about the effectiveness gains, the increased probability of good outcomes, the reduced risk of undesired results, not just the efficiency gains. And that's where, when you do this analysis, that's where you're really going to find the payoff of CLM comes through, is in the effectiveness gains. So Art, I think you've got some stories to tell about this as well. So I think it's over to you.
No, fair enough. Thanks very much. Andrew, I guess before we sort of transition to my side, are there good tools or good rules of thumb when it comes to anticipating the upside associated with the CLM? We all tend to look, at least as a vendor, at what kind of cost reduction, what kind of value we can drive by way of efficiency, process improvement, even cash flow. But when it comes to that future state, delivering better value to your CFO or to your compliance officer, what do folks normally look at? What's an acceptable approach there?
Well, as I said, it's all about calculating probabilities, changing probabilities. Now, this is a somewhat foreign concept to a lot of ROI calculations, but it's one that, for example, with Forrester, we have a methodology called a total economic impact, which takes traditional cost calculations or ROI calculation and adds to the variables of cost and direct benefits to other benefits, to other variables. One is risk. Anytime you do a technology, there's a risk of failure could arise. So calculating what that is. But the other is what we've traditionally called flexibility. And flexibility is one that I think we have underdeveloped. Essentially is designed around probabilities. Being able to think about ways this can improve your things in a probabilistic way. Now, there are some tools for calculating this. It's called option pricing theory. It's how you price an option for a foreign exchange contract.
Okay.
It's a way of calculating what the potential swing or shift in an outcome could be versus the expected benefit or loss that can arise. And so there are ways you can use option pricing theory, again, calculating change of probabilities times the impact of those probabilities to come up with a number. that you could use and put in that flexibility category of benefits side by side with the direct benefits of efficiency gains.
So the anticipation is, you know, you're going to have to pivot in the future. You're not quite sure which way or how much, but ensuring that you've got the capability to do so when you need it.
That's certainly the direct ones, but also can be applied to, again, changing the outcomes that you want to achieve. And again, for contracts, the outcomes are all about avoiding bad things, increasing the likelihood of good things. That's why so much of contract language is devoted to those areas. You know, identifying who's responsible when things go wrong and what needs to be done when that happens. How do the things that go wrong get fixed? When things go wrong, that's a bad outcome.
Oh no, I think that's in many ways a great segue into you know, what we look at here at Altria in terms of where you can start to, you know, derive some of that value. You know, to your earlier points, and to everyone on the call, the pre-award process associated with the contract lifecycle, facilitating the business engagement, ensuring that you've got a good, compliant, sort of self-generated contract. These are all things that are related to getting things done faster, oftentimes less expensive, and to some degree better, more efficient, but also in a less risky way. But yet the monetization of value oftentimes comes what I'll call post-award, after the execution of the contract, and now you're in that sort of run state of the contract itself. It's also, I believe, the right place for obligation and performance, and to some degree even risk management during the run phase. And this is where you can, to Andrew's point earlier, ensure that you're managing the outcome, that everyone wrote this contract to make sure that both parties delivered as spec and as appropriate. Being able to capture on an ongoing basis, because you have separated the various data elements, targets, goals, key performance indicators, milestones, etc., you know, give you that capability to get corrective action going early on in any relationship that you might create. To that end, you know, we've tried to put together something to help our customers and our prospects really get a grip on how to quantify some of that value. Now, rather than sort of go through PowerPoint, what I'm going to do is jump into a live Excel sheet, and let's just see if this new share thing works. Hopefully everyone on the call can now see a spreadsheet, simple Microsoft Excel with an input form. This is a model that we're happy to work through with anyone at any time. We'd also provide a copy of this after our call. But this really sort of enables, I think, a multidimensional approach to understanding some of the benefits that can be driven in very black and white ways. You know, ultimately the goal, of course, is to be able to sit across the table from a CFO and say, this is what I need, both in terms of the budget for a third party like ourselves, as well as allocation of project resource, staff, etc. We can just run through, I'll say, a relatively simple scenario. Let's take a setup where we've got, I don't know, let's say 20 legal professional non-attorneys that are involved in a contract management, contract lifecycle process, maybe 10 attorneys. Let's take a sales team of about 50 folks. These could all be Salesforce users, and then operational team members. These are folks who might be finance, compliance, audit. And if we take a look at how many hours each of these folks may be actively involved, let's say for the non-attorney legal, let's say 3 days a week. Maybe our attorneys are involved a day and a half a week. On average, of course, sales associates between 24, maybe even more than that. Let's say 32, 4 days a week. And others who may just be in there once in a while. If we take some of those loaded costs, this could vary, of course, based on the kind of folks that we have. But let's say non-attorneys, East Coast, Chicago, 120. Attorneys, hourly wage, let's bump that up a little bit for full loading at 200 or 220. And then take a look at our sales associates and you know, sort of the other professionals, and maybe we've got varying levels of annual salaries. Let's take an organization with, let's say, $2.5 billion in sales, maybe 1.2 in expenses that are addressable, non-headcount. And with that kind of organization, maybe 2,500 contracts a year. And as you know, Andrew had mentioned, there's some significant value around ensuring that your contracts that should renew do renew. Those that don't renew don't. Those that need to be renegotiated can be. So you can sort of take a look at what you've done historically and then forecast for the future for a percentage of those that ought to renew, as well as those that are renewed or rather negotiated every year. We have found that there are some things that change based on the kind of industry someone is in, whether it's manufacturing or whether it's services. And then we have this concept of the maturity model, which says, what is your sort of point of origination? Are you still manually signing stuff in file cabinets? Not likely anymore. Are you sharing contracts on SharePoint or some kind of common drive, maybe some basic indexing, or do you have a document management platform, or do you have a CLM? Have you looked at PostAward? Are you doing the kind of integration that we've talked about across the various stages from Andrew's model? But fundamentally, with some base input, we can go ahead and calculate some immediate value improvements. Now, it's easy to click a button on a spreadsheet and come up with a fancy graph, right? But really what we want to do is sort of drill down a little bit and be able to defend this when you're sitting in the CFO or controller's room. Now, just because they're a CFO or controller doesn't mean they don't appreciate a good picture. So as part of the toolkit that our team has built out, we have sort of thematically grouped across a number of measurement areas. So everyone likes to take a look at manpower reallocation. How can we do more with same? I don't want to say do more with less, but let's take some of those team members and reallocate, redeploy, maybe perhaps move them up the value chain. And just given the sort of input model that we just ran, what kind of savings or reallocation would we see in a pre-award mode, right, getting contracts executed, versus managing those contracts after the contracts have been executed? We've also bifurcated or split the core CLM from the CLM plus contract analytics. And we'll see as we look at some of the graphs how leveraging AI in a contract analytics mode can be useful at both the intake process and triage, as well as post-award compliance and performance management. That your contract analytics and your contract analysis plays differently, of course, on whether you're pre or post-award. So besides the thematics, and we can sort of touch these in very high levels, but given that we're I think the number was a $2.5 billion company, we had 10 attorneys, 20 non-attorney legal, a couple of dozen sales folks, we're looking at some pretty significant manpower reallocation benefits. And we can look at these across the different sort of segments to say, okay, we're going to drive this based on certain tasks and against certain job roles. Now, all of these sort of numbers have been built out, if you will, based on customer survey, industry best practice, and at the bottom of the sheet we'll actually show you the links that we used. So when we think about manpower reallocation, that also maps over to manpower saved, or hours saved. And here, across the various stages of the contract lifecycle. So this is in gross hours per week. Of course, you can run the average based on the labor category or the resource category that we talked through. But this gives you a sense of where the biggest impacts can occur, and also helps sort of leverage those discussions with the CFO who says, well, it's great that you can speed things up, but it still takes 9 months to make a baby. Oh, okay, hard to argue. So where are we looking at additional sort of value adds? Maybe it's in the renewal and renewal management perspective, being able to track ongoing contracts. And it's great to be able to highlight some of these, but maybe I need to go a little bit deeper. And to do that, we have the ability to take a look at the back end. This is the model sort of behind the scenes that enables us to really see where these efficiencies, where these impacts, where these values are being driven. And this allows you to sort of roll up your sleeves and to share with the controller where these numbers are coming from, whether it is hours, whether it is actual sort of cash results. And for those areas where the model can't necessarily understand the uniqueness of your business, we've provided additional factors that will allow someone to adjust these values based on industry trend, geography, market, or the things that are unique to you. So just on the procurement supply chain side as an example, which oftentimes is a very strong argument in front of a CFO, because when we talk about probabilistic and forecasting future and what the new upside may be, there's a certain amount of trust that you need to have with your CFO. However, if I'm simply looking at buying the same things I did last year and paying less money, that is a very black and white kind of argument to make, and one that arguably may be faster to prove out. So giving you some sort of key areas in the procurement and supply chain, whether it's savings based on vendor contract consolidations, savings from renegotiation of auto-renew contracts because the CLM gets you advance notice, gives you more time to prepare, gets you better armed, you've got information in front of you, you should be able to cut a better deal, right? Savings from off-contract expenses bought on contract. So this is sort of the value of having a good eProc platform, as well as avoiding last year's penalties. These are places where you have the ability to go in, affect your calculations, and move forward. Now likewise, if I take a look at the sell side, on the revenue side, what would be my benefit of being able to renegotiate long-term contracts or automatic renewable contracts with my customers? Again, we're not talking about anything that's a big stretch for the CFO to understand. This is simply, hey, 30% or 50% or 70% of my contracts are annual. They automatically roll over. They're evergreen. This gives me the chance to go in and upsell, cross-sell. What's a viable number? And have you both agree to it and be able to document, show, and then present. And of course, with all the backup required in terms of sources, resource, and data loads. So I certainly welcome everyone on the call to take advantage of this. Talk to your account teams, ping our marketing teams. Happy to run this with you, and then as a result, of course, I'll drop you the sheet as well as a PDF as needed. So just sort of coming back to our PowerPoint, as we sort of wrap up, we will be able to provide parts of the deck to everyone as and when it makes sense. Otherwise, unless we have any questions on the chat, and I'm just looking at that now, or any QA. I think we're good. Andrew, any closing comments before we wrap?
Sorry, it took a moment to find the unmute button. No, I think this is, what I'm hoping is that our audience found it useful, that they were able to take away from this at least some ideas as to how you would go and build that business case. I think the tool you've offered is a very nice one, Art. I think it gets sort of the direct benefits. But I think it's also important that you not ignore the indirect benefits, those effectiveness gains I talked about from CLM.
Now,
Because
Andrew, it sounds as though that's an offering that Forrester has. For anybody on our call that may also be a Forrester client, is that a value process that they can talk to their account execs from a Forrester perspective?
absolutely, we can help you put together a what we call total economic impact model for calculating the full 360-degree sources of value as well as cost from a CLM implementation.
Perfect. And certainly for those folks who are on the call today who may not currently be Forrester clients, I'm sure that we can work through Andrew and his team to extend that same capability to you, though I have a feeling that I'm going to end up paying for that, and that's absolutely okay.
Not at all. Anyway.
Andrew, thank you very much to those participants today who took the time to join. Very much appreciate your time and attention. Please do reach out with any additional questions or follow-up.
Very good.
Thank you, everyone.
Thank you.